Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm good, Bryce. You could say I'm nervously excited for our keen listeners out there who listen to our Jesse Felder interview re-release.
Yes.
They will be aware that we scrapped an episode due to the quality of the audio. And This was that episode. So if you're listening to this, it means the audio quality second time round was up to scratch. If this never sees the light of day, it means we're batting 0 from 2.
Our head of quality control stepped in and said, boys, do not release the last episode because we harp on about audio quality. So you know what, Ren, we listened and didn't release it, but here we are.
Our head of quality control is actually just Bryce's split personality.
Fresh back from Japan, Ren. Ready to get stuck back into... actually a week back from Japan.
Yeah, but, from what you were saying, not too fresh.
Yeah, look, still feeling the effects of...
that sake addiction you inherited while you were over there.
Get over it.
No, you get over it, mate. The addiction isn't good.
Sake being... If by sake you mean comic books, then yes, I am now addicted to comic books. So anyway, moving on. We had a great time. We had a great time in Japan. Just want to shout out to a few of the listeners who did reach out to us while we were over there, who were either living there or also touring Japan at the same time and wanting to meet up for a beer. Apologies for not being able to do so as our itineraries didn't line up, but good to know that we've got some listeners over in Japan.
We're big in Japan.
The Equity Mates flag. Yeah, and, huge. Bigger than Australia.
Also, an apology and a thank you to the Japanese Stock Exchange for allowing Bryce entry even though he was wearing shorts. Very disrespectful from him, but we look forward to releasing the content shot only from the waist up.
I hope so.
In the near future.
All our social media guy happened to catch all the photos from feet up, which was rather alarming given that I was in shorts. So yes, hopefully it is waist up only, Ren. Otherwise, not a good look. But anyway, keeping investing casual, that's what we're all about, aren't we, right?
That's it. Yeah, it's very on brand for us.
Exactly. So, Ren, today's episode, we are talking about the death of the unicorn.
Yes.
What do we mean by that? Well,
so
cutting off the horns of the unicorn back into a horse, is that right?
Yeah, public market investors have cut their horns off and revealed them just to be horses in disguise. And what do we mean by that? Well, maybe let's start with what a unicorn is.
Yes.
It's a term used for private companies that are worth more, or that are valued at more than $1 billion. Probably a decade ago, unicorns were quite rare, hence the name. But recently, unicorns have become more and more common as more and more venture capital is invested in some of these big tech companies. But what we've seen really in the last 6 months is that a lot of these unicorns are being found out, and especially when they go into public markets, so when they IPO and go on the stock exchange, they're really being found out as maybe not so much unicorns and maybe more horses. So we want to talk about it because it's a growing trend. They're obviously companies that we use and we're interested in. And look, maybe it's a buying opportunity or maybe it's a mini correction in the land of venture capital.
Yeah, big time. So let's just quickly touch on what we're going to talk about. So we'll start with a few of the bigger falls that we've seen in these big tech companies since IPO. Then we'll discuss what has created this sort of VC unicorn bubble and I guess what environment that has then gone on to create. And then we'll have a look at why perhaps this bubble may be ending and what it means for us as retail investors. But before we get into that, Ren, I think it would be a good idea just to bounce off each other our sort of idea of what is venture capital, because I think it's important to understand that in respect to unicorns and what we're about to discuss. So from my point of view...
Oh, and by the way, we haven't spruiked our live show yet. So just to go completely off course, 23rd of October in Melbourne, 29th of October in Sydney, equitymates.com/Finimize. Be there or miss out. All right, on with the show.
That is why Ren is not head of marketing, because it's a fast and loose approach. Anyway, we'll get back to that at the end of the show. So venture capital, Ren, from my point of view, is essentially betting on early concepts. It's a form of investing that I think has become, or we both know has become sort of that sort of sexy form of investing over the past 10 years. You know, placing bets on businesses that have really good foreseeable growth potential and, you know, where you can get returns rather than 10, 20%, you know, upwards of, you know, hundreds or even thousands % returns. So that's sort of my view on, or top line view on venture capital. Do you have anything to add from your point of view?
If you think about the life cycle of a company, you know, it starts as an idea and then it grows and it grows. And then at some point it's a big company and it becomes a public company, and then eventually it will die. If we think about what we talk about with Equity Mates, it's mainly investing in public markets, and it's generally investing in companies that are more mature, that have gone through the growth stage, or at least the initial growth stage, and are big enough to become public companies. And that's when then we speak about investing in them. Venture capital invests at a different stage in the company life cycle. It invests in the idea or like the very early growth stage. And so what you have is a different risk and return profile. So the risk is obviously a lot higher, because when you're investing in a company that is in the public market, it's already grown and it's already proven itself. It's not a bad idea. And then it's just about how they continue to execute. But venture capital is investing in ideas and early companies, a lot of which will turn out not to work or to be beaten by other companies. So you make a lot more bad bets in the land of venture capital. But the flip side of it is when you make a good bet, you make a lot more return on those bets, because all that growth trajectory that companies have, you benefit in. So you expect to pick a lot more losers, but you expect to have massive winners as well. So it's just a different stage of investing.
Yeah, nice. So there are a lot of great minds out there that have generated plenty of good concepts and great products and have benefited from venture capital, but they haven't always translated into sound businesses. So how about we jump into some of the bigger falls that we've seen on the market, Ren, over the last sort of year and a half, from companies that were once private and a good idea and have generated some great venture capital inflow and are perhaps now, I guess, being questioned by the market as to the validity of and the long-term success of potential for these businesses. So do you want to kick off?
Yeah, I think it's worth saying some companies are being questioned about their long-term prospects as a business. A lot of them are just, the market is saying they're overvalued. So the market isn't saying they're going to collapse and die, but it's just that they're not worth what private investors said they were worth. So if you hold some of the companies we're about to speak about, I wouldn't panic unless you're a WeWork investor. We'll get into it. Maybe panic.
Well, to be a WeWork investor, Ren, you'd have to be in private markets. So
yeah.
Shout out.
Maybe you don't know who listens to this podcast.
No,
I have a sneaking suspicion that Masayoshi, the head of the Vision Fund, actually is a listener.
I heard Warren Buffett is also an avid listener as well. Brushing up on,
I don't know
some
if he,
skills.
I don't know if he's on podcasts yet. I think he's still a
On the
newspaper
Telegram.
man. Yeah. All right. So anyway, what's happened? So for context, the S&P 500, the index of the 500 biggest American publicly traded companies, is up 18% year to date. Now that context is important because a lot of these companies that we're about to speak about have fallen even in a market environment that's gone up. So we touched on WeWork, WeWork was going to IPO. It wanted to go public and it thought it was worth $47 billion. Goldman Sachs had privately said it could go as high as $65 billion. However, it eventually had to pull its IPO, so it didn't go public because the public market wasn't willing to value it above $20 billion. And then like a week later, they fired their CEO. So that's probably the big one that's got headlines. But if you look into it, a lot of these other big tech companies have also had pretty shocking runs. So Uber is down 29% from its IPO price. Lyft is down 50% from its IPO price. Slack, the messaging app, is down 33% from its IPO price. Spotify, the music streaming service, is down 21%. And then in the last couple of weeks, Peloton, the fitness company, I guess you'd call it, it IPO'd 2 weeks ago, basically, at the time of recording, and it's already down 19% from its IPO. Have you got any other examples?
A couple that IPO'd last year, and I think Snapchat was maybe even the year before, but Snapchat is down 46%, and Dropbox, which I think was early last year, they're down 31%. So very much in line with the declines that we're seeing across some of the big hitters that you also just mentioned there, Ren, which is pretty amazing that you must think, you know, you've got some of what are supposedly the best investment bankers in the world bring these companies to market. And I guess they're the ones that tend to set the valuation at the end of the day. And it just goes to show that the public market pretty much is disagreeing with these big investment banks. And yeah, it's an interesting story, particularly WeWork.
Yeah. And I think the important thing to keep in mind is it's not like all of tech has had a shocking year. I think, so Facebook is up 33% year to date. Google, not Google now, it's Alphabet is up 14% year to date.
I think Apple's close to 30% as well.
Yeah, Amazon is up 12% year to date. There's a real distinction. It's not like all of tech is going poorly because you would say that somewhat explains it. Or even if the whole market was going poorly, that somewhat explains it. Another one, Microsoft, up 37% year to date. So you're seeing this really big distinction between some of the more established and importantly profitable tech companies, and then a lot of these more recent unicorns that have had sky-high private market valuations from venture capital that are now sort of being found out by public market investors.
Equity line. I was going to mention that P word, profitability. I think it's very clear with the companies that you just mentioned versus the companies that we have just spoken about that are down since IPO. You know, Uber and Snapchat, maybe even Spotify, Lyft, all these companies have gone IPO environments, well, when they're not even necessarily turning a profit and they're just chewing through cash. So versus, you know, the likes of Microsoft and Facebook and those sort of bigger tech companies that are profitable, it's very easy to see how the market thinks about them.
The stat that blows my mind, just to illustrate how unprofitable some of these companies are. So in 2018, both WeWork and Uber made a loss of $1.8 billion. And if you think about that, that's losing over 200 grand every hour through their operations. Like they are just burning money.
Jeez. That's incredible. And it makes you question why they continue to have money poured into them from the private markets. Like, surely there's a point where it stops. But anyway, time will only tell.
Well, I think that's a nice little segue into how this bubble has been created and why it was created, because I think that goes a long way to answering that question, why people keep pouring money into these companies.
Yeah.
Should I step back in history?
You should step back in history, Ren. I think, where did it start? Started with the iPhone release back in 2007, if I am not wrong. Is that your thinking?
Yeah, that is. So if you think about venture capital in the tech world, there was obviously the first tech boom in the late 90s and then the crash in 2000, 2001. And then there was a few quiet years in the world of tech. And then really the mobile revolution started with the first iPhone in 2007. And we saw some big early winners in that space. Facebook shifting to mobile, Uber. There was a bunch of other app-based winners. And what we saw was a lot of capital flowing into that space because of the opportunities that the iPhone and smartphones in general created. And then what we saw was obviously the GFC happened and people got skittish about public markets. And so a lot of capital moved to both private equity and venture capital. And then low interest rates since then have funneled more money into venture capital because all of these big institutions, big endowments, and just high net worth families and individuals are all searching for yield. And private equity and venture capital have really been the places where returns have been good in the post-GFC world. So what that then leads to is a lot of unsophisticated money entering the space. So if you think about, there's a class of professional venture capitalists who are very disciplined, who are very good at scrutinizing business plans, very discerning when it comes to how they invest and how much they invest. But as more and more capital floods the space and more people try and make money in venture capital because returns are good, that discipline sort of leaves the industry because companies can go to people who have a lot of money but don't have that investing discipline. And then what we have seen in the venture capital space is a surplus of capital, meaning that instead of startups competing for funding from venture capitals were actually competing to fund startups. And so it meant that to invest in some of these hot companies, especially companies like Uber, the companies could have basically named their terms. And so they were asking for larger and larger check sizes for smaller and smaller amounts of the company. And what we really saw was because of all this capital in the space, generally at some point companies need to go public to raise capital to really fund their next stage of growth. But instead of that, because there was so much money in the private market, all these companies just kept hitting up these venture capitalists for another funding round and another funding round, and they could delay going public. And so what we saw was these companies get to crazy valuations. WeWork, $40 billion, Uber, $60 billion, just huge amounts of money, even though these companies weren't profitable. And it's just because their funding rounds kept getting bigger and bigger and they could keep demanding higher and higher valuations. And then really what's happened is in the last couple of years, people have stopped funding them or, for whatever reason, people have wanted to get their money out. Uber had all their issues. Travis Kalanick left, and then investors wanted to get out. And now all these companies are getting found out in public markets, and people are realizing that in many cases, venture capitalists, because there was so much money in that sector, overpaid, and these companies aren't worth what they were valued at.
Yeah, super interesting. I guess it's pretty worrying. Well, not worrying, but you would think that they would have more discipline when it comes to investing large sums of money like this, because at the end of the day, they've gone public, and that's usually the way that these investment companies or venture capital firms actually make their money. That's their exit. And in fact, the market's finding them out, and I'm sure a lot of them are losing out. Yeah, super interesting. So what, I guess, has this created? Is it a stain on VC, do you think, Ren? Is this trend likely to continue? What do you think is going to happen there?
So I think we're probably at peak venture capital for this cycle. We've spoken about this SoftBank Vision Fund a few times, this $100 billion venture capital fund. There was talk of raising a second Vision Fund, but that talk, I'm pretty sure, has been shelved because they obviously had big investments in both Uber and in WeWork.
Yeah.
But yeah, even if you look outside the Vision Fund, just the number of mega deals that were happening recently were just absurd. So in 2018, the number of mega deals worth over 100 million would double just the year before, just 2017. So it was just accelerating at such a rapid pace. And I reckon what we're going to see is that slow down and some of that excess capital move away from venture capital and try and chase returns in another asset class. But look, at the end of the day, if you invested in Uber or any of these companies in the early days,
you're laughing.
You'd still made a great investment.
Absolutely.
So venture capital isn't dead, but maybe valuing a company that's losing money at $100 billion might be dead for the moment.
Yeah. And what's also interesting, Ren, is that you would expect some of these companies, well, at least based on history, some of these companies to be snapped up by other sort of larger tech companies. I'm thinking, Instagram, for example, was snapped up by Facebook, and they also approached Snapchat to be purchased, but that didn't go through. Do you reckon the fact that some of these larger companies, quite established larger tech companies with a history of acquisition, are not actually putting their hand up to say, hey, we'll buy you guys rather than go public?
Yeah, I think that's 100% right. It's a really good point. You look at a lot of tech companies and they either go public or they get bought by a bigger company, and that just doesn't happen anymore. And, we talk about companies like Spotify. Rather than Apple trying to buy Spotify, they just made Apple Music. We talk about Slack, the messaging company. Rather than Microsoft buying Slack, Microsoft has just made Microsoft Teams. Yeah, it is indicative of these companies being overvalued, that the natural companies that would have acquired them weren't interested in acquiring them, and in many cases just built replica themselves. So they must have known that it was cheaper to just build it themselves rather than to buy these companies. So I think, good point. It's very indicative of an overvalued market.
It will be interesting to see if this trend continues with some of these large tech firms, if they continue to fall in the double digits percentage-wise, if they do then eventually become an attractive acquisition target for some of the larger public companies out there. So I'm keen to see what happens in this space. So why is this bubble sort of coming to an end, do you think, Ren? What's sort of some of the key things that we should be considering when thinking about this trend?
Bubbles always end. Especially a bubble that like this, where it was just these companies were unprofitable, so needed people to keep funding them. No one has unlimited capital, not even SoftBank, and no one can afford to just continually fund a perpetually money-losing company. So it was going to happen, and it just seems like now was the time that it did happen. I think a few things probably led to it being now. There's obviously slowing growth because of the trade war and Brexit and all of that. And a lot of these companies continue to be funded because they have crazy growth rates because they keep acquiring more and more customers. And as the global economy struggles, potentially those growth rates start to slow down. But I also think there was just some things, like Uber went public because it had all of these issues, because it got rid of its CEO and because its investors wanted to make a return. And then everyone saw what happened when Uber went public. Its investors wanted a $120 billion valuation. It went public at $75 billion, and then it's fallen 29% since then. And then if you're another, unicorn company that's getting heaps of venture capital, you start to worry and you think, how are my investors going to realize their return? We need to go public soon. And that's why we've seen so many this year, I think, because everyone wants to get in while the going's good. No one wants to go public in a bad market environment. And so I think, we saw more companies go public. We saw them have pretty bad or pretty soft IPOs, and it's sort of snowballed into the situation where we are now, where we're having conversations about, these unicorns being shown as maybe not as good as we thought they were.
Yeah, super interesting. I think it is interesting to think about, how long a lot of these large tech companies put off an IPO. And then, in the last sort of 24 months, there's been a spate of quick IPOs with some of the biggest private tech companies in the world. So I think it seems like they're all trying to cash in as the going is still good. I'm trying to think of some other sort of large tech companies that are still private.
So I've got a few.
Yeah.
Why don't I tell you the name of the company and how much they're valued at, and you tell me if you would invest in them or not.
Okay.
All right. SpaceX valued at $33 billion.
SpaceX, so Elon Musk's space adventure. I mean, it would be I'd give it a crack. Why not?
Okay. Airbnb valued at $35 billion.
I like it, but I probably wouldn't be investing in Airbnb at 35 bill.
Yeah, I think Airbnb is marginally profitable, but 35 billion is a lot. I love it as a company.
Yeah.
What about this one? Joule Labs, valued at $50 billion.
Crazy valuation, I think. Just crazy valuation. So Joule is an e-cigarette manufacturer. Look, an industry that is addictive, that's for sure. And I can see it being a very good acquisition target for perhaps the likes of some of the larger tobacco companies in the world. But at a $50 billion valuation, you're putting it up there with probably in the top 10 most valuable public companies in the world, maybe. I don't know. So in terms of tech anyway. No, definitely not.
So, I think given the fact that it's getting regulated and banned in schools and all that stuff, 50 billion might fall away very quickly.
Yeah.
But just to illustrate your point before, so your point about none of the natural acquirers acquiring any of these big tech companies, I've just looked up Philip Morris's market cap. So Philip Morris is obviously one of the biggest tobacco brands in the world, and you would think acquiring a company like Juul would be right in the wheelhouse for a company like Philip Morris.
Yeah.
But Philip Morris's market cap is $121 billion, and Juul, this startup, is valued at $50 billion. So it's just not possible for a company like Philip Morris to then make that acquisition. So there's an effect of these massive private valuations that these kind of, like Juul as a company really has no choice but to go public if its investors want to realize the return.
Yeah, it's a tricky situation for them. Any others?
Oh, look, there's a bunch. What about this one? Peter Thiel's Palantir Technologies.
I actually don't know anything about it. What's it valued at? What do they do?
It's valued at $12 billion. It's like this top secret data science company that basically works with like the CIA and the US military and now some police forces.
God.
It's like Peter Thiel, the founder, the early investor in Facebook. It's very secretive, but I think it's a very interesting one. Give it a Google.
If you say any more, we'll have to kill you.
Yeah, well, no one knows anything about it, but like, because no one knows much about it, you can obviously be very conspiratorial about it.
Exactly.
What do you reckon the highest valued private company is at the moment?
In the world?
Yeah.
Tech or no? Highest valued private
It is a
company.
tech company, but I think this is just full stop. I'll give you a hint. It's valued at $75 billion.
Oh, it's not the Saudi oil company, is it?
Oh, look, I think you've actually beaten me. I think that is valued at more than $75 billion.
What's it called again?
Saudi Aramco.
Aramco, yeah. They're looking at taking that public at some point, aren't they? What did you have? Did you have like...
The most valuable company on this list that I have of unicorns is a company called ByteDance, which is a Chinese artificial intelligence company.
Oh, interesting. There you go.
Became a unicorn in 2017 and was valued at over $1 billion in 2017. Just 2 years later is now valued at $75 billion. That's pretty crazy.
That's ridiculous.
But it shows, again, the trajectory of these valuations has just been so rapid.
Yeah, the desire for return and yield and, crazy bubble we're seeing by the sounds of it. Nice, Renwell. I mean, we don't want to discourage anyone from investing in any of these companies that we've discussed today. As you said at the start, it doesn't necessarily mean they're bad businesses by any means. It just means that perhaps they're more overvalued than they thought that they were worth. So if you're invested in them, as Ren said, don't panic. In fact, actually, no, I'm not invested in any of them. Are you?
I am not at this time. There are some that I actually am pretty bullish on over the long term. So I it's like Amazon and Google and stuff. In 2000 and 2001, they got punished as the rest of the tech sector fell in that first bubble burst. But the quality bounces back. And I think there's definitely some quality companies in the list of unicorns. But yeah, I think it's probably not going to be a fun end of the year for them.
Yeah, agreed. All right, Renwell, always good to chat stocks. Enjoyed that episode. As you said very briefly at the start, if you're in Melbourne on the 23rd of October, 6 p.m, we're doing a live show with a panel of vets from the Equity Mates community who have been on the show before. So get on down. Tickets are available at equitymates.com/
free tickets.
Free tickets. equitymates.com/Finimize, FINIMIZE, as we're partnering with them. And likewise, Sydney, we're doing 29th of October, 6 p.m. both at the General Assembly buildings in the cities. Tickets are free, beers and wine are free. Chatting to Ren afterwards is also free. So by all means, we're looking forward to
seeing Bryce live is priceless.
We will have our Equity Mates, brand new Equity Mates shirts on as well, which we will hopefully have available for sale.
Can't wait to see them.
So looking forward to it, Ren. Get your tickets. They are selling out like hotcakes, we hope. We actually have no view on that, but anyway.
We have some view on it. We know there's going to be a few people there.
Yeah, our parents. Anyway, all good, and we'll chat next week, Ren.
All right, sounds good.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.